So it continues to be a volatile period for investors in stock and bond markets around the world. And while the news, like the weather, has been a little bit gloomy this spring, summer is right around the corner. Maybe it's time to think about ways to make the best of it. I'm Kent Kramer. I'm the Chief Investment Officer at Foster Group, and I'm joined today by Matt Moklestad. Matt's a lead advisor at Foster Group, and he's part of our investment strategy group. We're going to talk about some things today related to that. Matt, continues to be a tough market out there. Tell us a little bit about what's been happening recently.
Yeah, absolutely. Well, you're right. It's certainly a volatile market, and there's never a lack of news that we could cover, right?
Yeah.
So just hitting on news over the last couple of weeks, probably two main points here. First, inflation continues to be top of mind for investors. There was an inflation report last week, and it came out, it rose 0.3% in April and is up 8.3% from a year ago. So still persistently high. It did go a little bit the other direction. It was 8.5% in March. So at least we're going in the right way or the right direction, but still fairly high inflation. And then the next point probably is the S&P 500. It did fall into bear market territory last week. So that's a 20% drop from a previous peak. So certainly things are volatile out there. If we look at investment markets over the last 2 weeks, this is just a picture of it. We look at this pretty frequently. Just some major indexes from across the globe. And we have, you'll see there just at the bottom, just over the last 2 weeks, the S&P 500 in the purple and the Russell 2000, which is US small cap stocks in the light blue, down over the last 2 weeks, and the rest are fairly flat. Bonds are actually positive for the last 2 weeks. Interest rates went down a little bit. But that's our picture. If we fast forward, turn the page and look at year to date, here's our picture. As you can see, everything's still down in that double-digit territory through the end of last week. So yeah, certainly some volatility going on.
It has been some volatility. It's a little gloomy, but it is important especially when we're looking at stock markets, to continue to try to think long-term. We continue to think stocks have an important part in investors' portfolio, especially investors who are looking for long-term growth. And that's true even when we have periods of downturn like this. So with the recent decline in markets, I know one of the things that happens often is people start asking, well, what should we be doing? Or should we be doing something in response to what we're seeing in the market? So Matt, since I've got you here today, I'm going to pose that question to you.
Right.
Matt, what should we be doing, if anything, given what markets are doing?
Well, there's certainly that desire, right? And at Foster Group, you know better than I do, that we really try to focus on what are those things that we could control. And there's a handful of things on that list. We're always talking about let's understand our plan, our spending, our income, our cost. But another thing that we want to talk about today that investors can focus on is tax loss harvesting. So the first question I usually get when talking about tax loss harvesting is, what is it? What is tax loss harvesting? And to start at a very high level, first off, it applies only to taxable accounts. So your IRAs, your 401ks, just throw those out. Don't think about those. It's only your taxable brokerage accounts. And really what it boils down to is tax loss harvesting provides a way for investors to potentially lower their tax bill today and in the future. And the best way to illustrate this is just to go through an example. So I'm going to do that. So let's say if we go to our example here, we have investment A. And an investor purchased investment A. They put on $100,000 into this investment. And let's say markets get a little bit volatile, maybe a year like this year. And over time, that investment actually decreases in value. So in this example, that investment decreases to $80,000 in value. So you're off by $20,000. So you have an unrealized capital loss. Now, when tax loss harvesting, what we do is we look for investments like that, and we want to realize that loss.
Yeah, which is an important characteristic, right? Because when they're unrealized, we don't like them because they still show up negative on our statement. But when they're realized, we can take that and now we can use it. The IRS will let us use that loss for, in this case, what you're talking about is maybe a way to get a tax benefit.
Exactly. So we realize the loss. And in this case, we sell investment A. Now we have that $20,000 loss that you just explained. So what might go to some people's mind is, why in the world would I want to realize a loss and kind of lock that in?
Yeah.
Well, that's not at all what we're doing here. What's important is if you think about an asset allocation pie, is that you might remove an investment, realize that loss, but in tax loss harvesting, we immediately reinvest those proceeds into a similar yet different security. So maybe it's a large cap blend fund. You sell it, realize that loss, and you immediately purchase into, say, an S&P 500 ETF. So you maintain your picture, your pie, your exposure from where you were.
Right. Which is important, right? Because like the one you just said, hey, a large blend mutual fund, it's holding mostly US large company stocks. So I sell that. I've got $20,000 in cash. Now I'm going to take that and I'm going to buy the S&P 500 index ETF, which holds US large companies. So my market exposure in that case stays the same, but I've realized the loss, which now can become valuable.
Exactly. So I'm going to go through an example to show you how valuable it can be. One note here, you'll see at the bottom, we want to be aware of what's called the wash sale rule. And first and foremost, you always want to talk to an advisor, a tax advisor, before you do anything like this. And we're not tax advisors. But the wash sale rule, basically what that means is that you can't sell investment A, realize a loss, and immediately purchase that same investment. You have to purchase something different, which is what we just talked about.
For at least 30 days.
At least 30 days.
Yeah.
Thank you. Yes. So to illustrate the benefit, we'll just continue this example. So we just realized that $20,000 loss. But let's say earlier that year, you sold investment B. Really unique names here, right?
Yeah.
You sell investment B, and let's say in that investment, you actually earn money and you realize a $10,000 gain. So because of that gain, it's a realized gain, you have a tax bill on that. And let's say you just have a 20% capital gain rate on that $10,000. That's a $2,000 tax bill. Because we realize that loss, what we can do is actually offset gains with losses. So in this example here, you'll see we have the $20,000 loss, that $10,000 gain. Basically, we net those out, we cancel that gain, and now we no longer have that tax bill.
Right.
And we actually have $10,000 left over, which can be used to offset ordinary income up to $3,000. Or you can just carry forward. Let's say you did reduce your ordinary income by $3,000. You have $7,000 of capital loss left. You can carry forward that into future years to really do the same thing.
Yeah, it's really nice. And those losses can roll forward for almost an unlimited amount of time. You just keep rolling those things forward because the likelihood is, we hope, markets will recover. And in the future, we'll probably realize some gains. We need to do things, either take money out or rebalance portfolios, whatever it might be. So it's nice to have those losses available to offset future gains, even if maybe those gains occur in years beyond this one.
Exactly. So in summary, again, it only applies to taxable accounts and it provides a way to potentially lower that tax burden. That's just something that we do on behalf of our clients in their taxable accounts. And we're reviewing this year already. So yeah, pretty neat concept.
Yeah. And it's a great answer to the question. Sometimes we feel like there must be something I can do to make the best of it in this situation where markets really aren't giving us what we want. Kind of takes me back to where we started, where we talk about summer is coming, which I'm ready for a little summer after a gloomy spring. And with summer, sometimes we have lemonade stands. I don't know about your kids, but my kids had lemonade stands. I like to stop at lemonade stands. It reminds me of this quote or this idea. When life, or in this case, the market, gives you lemons, hey, this is a way, at least from a tax point of view, to make some lemonade out of that situation. So Matt, thanks for joining us today. We always like to have your questions come in. Thank you for watching. If there are questions you'd like to hear us address in future editions of Financial Perspectives, please let us know at the contact information you see on the screen. And if you'd like to meet with a Foster advisor like Matt, you can also use that same contact information to get a hold of Foster Group and set up that appointment. We can talk with you about a variety of investment strategies and financial planning ideas as well. So thanks again for joining us. We look forward to seeing you in a couple weeks.